Hi, everyone. I hope you can hear me. I think you can hear me. My name is Amy Mertz, and I'm the Director of Major and Planned Gifts here at Groundswell Conservancy. Thanks for everybody for joining us today for charitable giving considerations. Appreciate you taking the time out of your day to join us, whether you're in person or on Zoom. I just wanted to mention a couple of events we have coming up today, or today mention a couple of events we have coming up in the next couple of months. And the first one is our Phoenix sculpture burning out at Patrick Marsh Conservancy Park, and that is on Friday, March 20th, which is the first day of spring. We'd love to have you with us. It starts at 4 o'clock. And the other event that we have coming up is our thank you party, and that is on Thursday, April 23rd at Madison Public Library Central. And that starts at 5 p.m. So we would love to have you for either of those events. You could sign up on our website. And on to today's presentation. So today's presentation will focus on some of the new tax changes that affect charitable giving starting in 2026, and some practical strategies that you can use when you're planning your giving. We're very grateful to have Danny Frederickson and Emma Mueller here. They are from Wealth Enhancement Group, and they are going to share their expertise today. If anybody has a question and is joining us on Zoom, you can use the chat feature to ask your question, and we'll do the best to have them answer that toward the end of the presentation. And also we're recording today, so just letting everybody know we are recording, and we will send out a recording of the presentation along with the slides on Monday. With that, I will turn things over to Danny and Emma.
Hi, everybody. Let me get my presentation shared here. All right, so today we're here to talk about intelligent and impactful giving strategies, as Amy said. So I'm Danny Frederickson. I'm a Vice President Financial Advisor here at Wealth Enhancement Group. I'm joined by Emma Miller, who's also Vice President Financial Advisor with us on our team. Couple of things just from an intelligent and impactful charitable giving standpoint. So there's really three steps to the intelligent and impactful giving framework. So number one is doing your due diligence. Number two is determining the best way to maximize your support. So that's going to be the core focus of what we're going to talk about today. And then just staying connected with the organization. So there's really four things to consider when you're doing your due diligence. So relevance. So is the cause you're supporting relevant to you? Is it important to you? The impact. So learning about the organization's accomplishments, goals, challenges, and determining if that aligns with your core values. The sustainability, so ensuring that the organization's a 501c3 public charity, and then reviewing the organization's finances. Are they transparent? Are they accountable? And then finally, leveraging tools such as Charity Navigator or Charity Watch, making sure that they have a high rating, and you know how your funds are being spent through your giving. So the best ways to maximize your support. Emma, you want to take this?
Sure. Yeah. So there are obviously a few benefits for giving financial support to organizations. First and foremost is being able to donate to a qualified charitable organization, that is a 501c3 organization, can entitle you to a deduction against your income taxes. So if you itemize, you are able to take advantage of that additional deduction against your income. Also, if you're looking at maybe bunching your deductions, that in and of itself can help with deductions off of your qualified medical expenses. A little bit more challenging there, as it has to exceed 7.5% of your modified adjusted gross income for it to be deductible. But again, it is a unique way to not only give support, but claim additional deductions as well. Then in looking at your giving, you can certainly look at reducing your income taxes by donating, excuse me, by contributing to these organizations, and it in effect will lower your Medicare premiums. So depending on how you give, that will then show up the following year. Annual gifting helps reduce your total taxable estate. We'll get through that in the next couple of slides with regards to looking at maybe RMDs. Giving from your RMDs to the organization will lower your IRA balances, which will then help with your overall taxable estate as well.
Yeah, so four ways to do this. Itemizing and bunching your deductions, donating appreciated assets, donating your required minimum distribution through a qualified charitable distribution, and then donating through a donor advised fund or a DAF. So first and foremost, just itemizing and bunching your deductions. So the example on the right side of the screen here is in year one, if I have a state and local tax deduction of 10,000, mortgage interest of 4,000, and nothing less, my deduction would be 14,000. While the standard deduction this year for married filing jointly is 32,200, I would want to take the standard deduction. However, in year two, in this example, I'm still having 10,000 of state and local taxes, 4,000 of mortgage interest, but I do a $25,000 charitable donation. That gives me my deduction of 39,000, which is greater than the standard deduction of 32,200. So for those who may fall below the standard deduction in any given tax year, it may make sense to hold off on 1, 2, or 3 years of charitable giving in order to make a big gift in a specific tax year, in order to get the itemized deduction and have that higher deduction strategy.
And that's the benefit, of course, of bunching those deductions in later years.
Yeah. So the second one is donating appreciated assets. We deal with a bulk of this with our own clients. So on the top line there is the being less tax efficient. So you sell a stock, XYZ stock, you have $10,000 worth of capital gains in there. You pay 15% on that 10,000. So when you go to donate the cash or the proceeds after the taxes, your only net gift is $8,500. On the bottom line is the more tax efficient way to do it, the more impactful way to do it is by donating stock XYZ, not selling it, but directing that stock to be gifted directly to an organization, Groundswell. They would receive that full $10,000 gift, exempt from capital gains taxes, and they would receive the full benefit from that. You would receive that full benefit from the $10,000 deduction. And then the charity can decide if they want to immediately sell it and take the cash for use of operations, or if they want to continue to be invested in that asset in the investment account. But again, getting that full benefit from your gift to the organization. The third one is the donation of your required minimum distributions to a charity through a qualified charitable distribution. So from left to right, you can take cash, you can donate it to a charity, and you don't really get the tax benefit there. The second line is the IRA RMD. You take your RMD, you pay taxes on it, and then you donate it. You're not getting the tax deduction there because you're paying the taxes on it. The tax benefit comes from when you have an RMD, let's say it's a $25,000 RMD, you are going to say, I want to gift all of that $25,000 through a qualified charitable distribution. And what you're doing is you are directing that full $25,000 to be gifted to a charity. And that's a dollar for dollar reduction when it comes to your tax benefit, meaning that if you have taxable income in any given year of $100,000 and your required minimum distribution is another $25,000, well, instead of paying taxes on $125,000, you will have shown that you've satisfied your RMD, but your taxable income remains at $100,000 because that qualified charitable distribution essentially bypasses that.
And the custodians that you use that hold these assets for you, your IRAs, can help facilitate any of those transfers for your QCDs.
Yep. And so RMDs, required minimum distributions, are really an unavoidable part of life if you have any sort of tax deferred assets. So when you hit a certain age, it's the amount that you must withdraw that the government is telling you to do it. It has to come from 401ks, 403bs, traditional IRAs, SEP, simples. They start when you're currently age 73. They will go up to 75 in the future. And you have to pay the taxes on the assets that you have accumulated tax deferred growth on for your entire lifetime, the government is essentially telling you it's now time to pay the taxes on this that you've been deferring for your entire life.
What is unique, though, you can do it also on inherited IRAs as well. So there is the tax component and the years in which you have to deplete inherited IRAs, and you are able to do these charitable giving as well outside of these inherited IRAs.
So the conundrum that a lot of retirees deal with is that RMDs get bigger over time. So there's a formula that RMDs go through, and they're based on your IRA balances. Typically, your IRA value is going up, and so is the factor that you have to take out. So in the example on the right-hand side at age 73, about 4.1% of your IRA balance must be taken. So you have $40,000 that must be taken. If you go all the way down the slide to, let's say, age 90, well, that turns to 8.8%, and you have to take out 73,100. When we look at retirement and retirement spending, it's not a consistent line. You don't spend more when you first retire and less at the end of retirement. What it typically looks like is on the right-hand side, where spending might spike in the first couple years in what we call those go-go years. And then you have the slow-go years where you may not be traveling as much, may not have as many expenses. And then towards the end of life, it spikes again due to retirement costs. So we end up with this gap to where you are spending less, but you're required to take more out of your IRA accounts in terms of required minimum distributions. So you have this extra taxable income. This is the perfect time to create a qualified charitable distribution plan so that you are not necessarily paying taxes on money that you don't need, but rather you can gift that money and receive the full tax benefit as well as the charity receiving the benefit of your gift.
And remember at the very beginning when I was mentioning your Medicare premiums could be going up. If you have this extra taxable income that you are required to take out, now you're being taxed at that higher rate, which then could in fact impact your Medicare premiums. So this is a solution for how to navigate that.
Yeah, and so just a couple notes on qualified charitable distribution. So even though the RMD age is now 73, you can actually start the qualified charitable distributions at age 70 and a half. So that did not change in the Secure Act. They left that at 70 and a half. So even before your RMD start, you can begin doing these qualified charitable distributions from your IRA account. It's up to $111,000 annually per person. That's for 2026. That is going to be indexed, so that's going to continue to go up, and that number is going to change year over year. An important note is that your qualified charitable distribution cannot be transferred to a donor advised fund. So it has to go through the QCD protocols. The last one is donating through a donor advised fund. So what this is you're going to open an account that is a Fidelity and Schwab have very good ones, and you're going to say, I have appreciated Apple stock, appreciated Microsoft stock, and some cash. And so what I'm going to do is I'm going to take those appreciated stocks and cash, and I'm going to gift it into a donor advised fund. You get the immediate tax deduction in that year, but what you're allowed to do then is you're allowed to spread those gifts over multiple years. So I'll give you an example. If a client of ours has $50,000 of a donation that they want to make to their donor advised fund, they can gift $50,000 and take that deduction in that single tax year. And what that allows for them and us is to do good tax planning in that tax year because we have that $50,000 deduction, but they don't necessarily have to give $50,000 right away. They can give $10,000 over the next 5 years in order to deplete that donor advised fund and complete their gifting. A couple of changes that happened this year, as Amy mentioned, that we're going to talk about. So there's really three big ones that happened from the one big beautiful bill that went into effect for 2026. The first one is the standard deduction charity break. So even if you do not itemize, you can claim a deduction for cash gifts to a 501c3 organization. $1,000 for an individual or $2,000 for married filing jointly. The contributions must be made in cash directly to the 501c3 organization. You cannot claim the deduction by gifting cash to a donor advised fund. An important distinction there, though, is that you can do the gift of cash and claim the deduction, and still do a donation from the donor advised fund. So you can do those both. You just cannot do them in combination with each other. The second point on this slide is the 0.5% AGI floor, 0.5% AGI floor. So starting in 2026, you can only deduct charitable gifts that exceed 0.5% of your AGI. So the example here is if you make if your adjusted gross income is $200,000 and you donated $2,000 throughout 2026, well, your AGI floor, 0.5% of 200,000 is $1,000. Only the amount above 1,000 would be deductible. So in this case, $1,000 would be deductible, not the full 2,000. So the strategy here is to bunch deductions. So the first strategy that we talked about would help clear the AGI floor on this. And then the important distinction here is that qualified charitable distributions are the exception to this rule. So if you're doing qualified charitable distributions, they do not, this rule does not apply. And then finally, the third one is the 35% deduction cap for high income donors. So there's a 35% limit on all itemized deductions for those in the highest income tax brackets. So let's say you're in a 37% tax bracket. You will only receive the lower effective tax bracket of 35%. So if you make a $2,000 contribution, you'll only receive a $700 tax savings versus what it would have been $740 in 2025 because you would have received that 37% tax bracket, whereas in 2026, you're only receiving the 35% tax break.
Great. And so kind of this is the final step, obviously staying connected with the organization. So Groundswell, of course, has their newsletter. So finding out how your financial gifts are to be used, or how are they being used right now. You can certainly go on to the newsletter to see how what your gift is being impacted as of today. And then determine a long-term gifting strategy, whether that is QCDs, whether that's using a donor advised fund, whether it's direct cash gifting. Each person has their own setup for how they would like to donate, and we're happy to have that discussion with anyone that has questions on how best to navigate that. And of course, consider giving more than just financial support. There's ways to volunteer. We as a team have actually volunteered with Groundswell for some clearing of some brush and have really enjoyed that, and we'll likely do that again this year. So just to recap a couple of things. So one, do your due diligence. Two, determine the best way to maximize your support to the organization, and of course, stay connected with the organization. So thanks for having us today. And I don't know if there's any questions out there right now. I see there's one comment in the chat, but I didn't know if that was one from earlier or not. But thank you very much for your time today. Got the thumbs up from Amanda.
All right. If nobody has any questions, yeah, thanks again for joining us. And if you do have any follow-up questions, feel free to reach out to me or to Danny and Emma. I'll make sure to send their contact information next week when I send out the recording. And that's it. Thanks for joining us, and have a great rest of your week.
Thanks everybody.
Thanks, everyone.
Thanks, Danny.
Glenn,
Thanks,
for the comment.
Emma.
Bye.